Hello, everyone. Welcome to our first part one of our discussion of Chapter 9 and tax credits. Now, before we get into the details of the various tax credits, some overall concepts of tax credits. These happen after we calculate our tax liability. So we take out any deductions, we get our taxable income, any itemized deductions, all that sort of thing, and from the taxable income, we calculate using either the tax tables or the tax rate tables the tax liability. Then we look at what tax credits we have available to reduce that liability. So they count as like payments towards that liability. Now, the two types of tax credits. There are those that are refundable, which means that if they are more than our tax liability, we will be able to receive a refund of any extra. So if our tax liability is $500 and the credit is $1,000, or $800, let's say, then we would get the other $300. The first $500 would be used to pay our tax liability, and the other $300 would be refunded to us. Most tax credits, though, are non-refundable, and therefore they are only good up to the amount of your tax liability. And if you don't have tax liability, then the tax credit won't do you it won't provide any benefit. So if your tax liability is $300 and your tax credit is non-refundable and is $500, you're not going to get the other $200. You're just going to have your tax liability wiped out to zero. So that's the difference between a refundable and non-refundable credit. So this first credit that we're going to talk about is for the child and dependent care expenses. This is a non-refundable credit. It is available when you have to pay expenses for child care or some other dependent care. It could be an older parent or someone that we are responsible for caring for that's a dependent of ours, that we need to pay someone else to take care of so that we can go to work. All right? So that's what the issue is. So qualifying expenses, those paid for household services for qualified individuals so the taxpayer can be gainfully employed. For children, they have to be under 13. They have to be incapacitated if they are adults. And then there's some limits on who you can pay. And you're going to have to make sure that that income that you pay them to care for these dependents is going to be reported, because you have to report it. They're going to have to report it as income. So no under-the-table payments are going to work for this. Okay, so the qualifying individual is for age under 13, and it has to be a dependent. That's like we just said, or a spouse is incapable of caring for themselves or her, so incapacitated in a way that they need to be cared for. So the way that this works is it's a percentage of the amount paid. So it's never 100% of the amount you pay for the child care or the dependent care. It's always a percentage, and that percentage, as given in your textbook, phases out, gets lower as your income goes up. Okay, so the highest, is 35% of what the care expenses, and the lowest is 20%. It never goes to zero, though. All right, it never goes to zero. So it's the percentage of the lowest of three calculations. Okay, so it is either the expenses that can be the amount you pay for child care to the daycare center or to a babysitter or whatever, or $3,000 for one child or $6,000 for two or more. Notice it does not increase with the third child or third care person that they're providing care. It is 1 or 2. That's the limit. $3,000 for 1, $6,000 for 2. So if you spend $24,000 on child care, you're still limited to either 3 if it's 1 child or 6 if it is 2 or more. Now, remember I said there was 3 limits. It's either the amount that you spent, if it's lower, or the $3,000, $6,000 limit, or it's also limited by the earned income of the lowest paid spouse. So if there's 2. Now, if you're a single parent, head of household, then obviously you just have to have earned income from that individual. Okay? But when there is married filing jointly, then it is the lowest income of the income of the lowest paid spouse. Now, they made it an issue in the law, okay, if the lowest paid spouse is incapable of care or is a full-time student, that non-working spouse is treated as if they had earned $250 per month if there was 1 child being cared for, and $500 a month or 2 or more. So that, if you look at that $250 for 12 months is $3,000, $500 for 12 months is $6,000. That would be the same limit if they were a student or incapable of care for the whole year that we had in our limit on the earlier slide, $3,000 and $6,000. Okay, so if you're a full-time student or you're incapable of care, then that in and of itself should not reduce how much of your credit you get in this case. If, though, neither one of those applies, then that they have no income, then you're not going to get this credit because they would be the lowest paid spouse, maybe stays home, doesn't work where they make money. Now, where this really can hurt a couple is when the lowest paid spouse maybe has their own business. So you still need care for little ones or whatever, but perhaps the business is just getting started and doesn't have much income yet, no profit, showing much profit yet, then that could limit your credit substantially, especially if that new business didn't make any income at all. You would not be entitled to any of the credit because the lowest paid spouse would have 0 income based on starting a new business. Here's how it phases out. You see at $43,000 we're already at the lowest percentage, and then it doesn't phase out anymore after that. And the highest percentage of your income's got to be way under 15. You're going to be under 15. That's way very low. Okay, so a couple of examples. Credit for dependent care expenses. Okay, single mom, 1 dependent, so we don't have to worry about 2 spouses and figure out the lowest paid. She has 1 child, age 7, needs care. AGI is $75,000, so she passed that 43, so it's 20%. She paid $4,500 to a qualified daycare, but because that would be over the amount that's limited for $3,000 for 1 child, then she can only use $3,000, not the $4,500. And obviously her income is not a limit in this case. So $3,000 times 20% equals the $600. So a little different example, we have a widower cares for his son. Elio is 4. So again, single parent. AGI is considerably lower in this case, $24,000, and pay $2,900. So under the $3,000. Okay, and received $1,000 of dependent care assistance from an employer. So the employer helps him pay That means we can't count all 2,900 because we got help. So we take the 29 minus 1,000. That's 1,900. And then our percentage is higher in this case than this other example because of the AGI being lower, 30%. But we're using not the 3,000 because we use the lower, in this case, of the expenses, the income, or the 3,000, 6,000 limit. And in this case, the actual expenses paid was the lowest, especially after you subtract out the $1,000, so 570 is the credit. There's also credit for if you're over 65 or permanently and totally disabled. Okay, 15% allowable base. This is very rare because of Social Security. Most of those folks over 65, because of Social Security, receive a lot more than what would qualify for this credit. Notice how low these amounts are, okay? And the Social Security pushes you over that, then you're not going to qualify. So this is pretty, doesn't happen very often, but here's an example. If their AGI is only 12,000, or whatever we're finding jointly, 5,000, okay? Minus their non-taxable security, we get half of the AGI over 10. So your credit would be $375. All right, much more common and things we have to deal with is the education credits. Really, two major education credits: the American Opportunity Tax Credit and the Lifetime Learning Credit. The American Opportunity Tax Credit is the better of the two, the more generous. It's also refundable, partially refundable, while the Lifetime Learning Credit is not. So you always want to look to see if you qualify, or your taxpayer, your client qualifies for the AOTC, and only if they don't we want to look at the Lifetime Learning Credit. Okay, so first of all, you have to have higher education expenses. All right, and they have to be for the taxpayer, spouse, or dependents. So when the child grows up and becomes independent, and you pay that, then you can't. If they don't qualify as a dependent, then you can't count the cost you pay for them for school towards this credit. So that's an important issue with determining if someone's a dependent, back when we learned about that in Chapter 2. We do so on this whole thing, or claim these credits, on Form 8863. So what counts as expenses? Tuition fees and books, but notice that there is not room and board and some other things. So basically those direct costs that you would pay for school. And it's pretty broad in terms of what institutions, any institution that is eligible to participate in the student aid program, is almost everyone. But it is something to consider that it is actually to a school that qualifies. So AOTC, like we said, is better. It's calculated 100% of the first 2,000 of qualifying expenses. So you add up those expenses, and as long as you have 4,000 or more, which isn't too hard to do in a year, the maximum is 2,500. So it can't go over that. So that's first 2,000, 100%. Second 2,000, 25%, which is 25% of that second 2,000 is 2,500. If your expenses are lower than 4,000, then your credit would be lower than the 2,500. This is per student per year. So you could have this credit for, if you had 2 children in college at the same time, you could take this on each one of them. On the other hand, Lifetime Learning Credit is 20% of qualifying expenses up to 10,000. Okay, so its maximum credit is 2,000. That's per taxpayer. So if you can't do it for each child, your maximum is 2,000 for all your wife, your spouse, and your dependents. And you can't use both credits in the same year for the same expenses. Okay, so you got to pick one and pick the one that's going to be most beneficial for your client. So they do phase out, meaning once you've calculated your tentative credit, if you will, if your modified AGI is higher than 80,000, okay, or 160 if you're married filing jointly, then it starts to phase out. You're going to get less of that credit. It's going to be reduced. And they're completely gone by the time you get 90 or 180. So basically, as long as it's 160 or below, you get the full credit you calculated. 160 to 180, if we're married filing jointly, you'll get part of the credit, okay, depending on how much through that range. If it's over 180, you're going to get none of that credit. Lifetime learning credit, different phase out numbers, okay, but similar in that the phase out range is the same size, meaning for single it's 59 to 69, so it's 10,000 phase out. 118 to 138, 20,000 for married filing jointly. Notice that these are lower for lifetime learning credit, another disadvantage of the lifetime learning credit, than they are for the AOTC. These are actually adjusted for inflation each year, while the AOTC credits, though, have not been, and so they have stayed the same for a while. So how do you calculate that? Married taxpayer, you can start with the upper range of the phase out and subtract your adjusted gross income and divide by 20. That'll tell you how much you keep it. Or you can start at the bottom of the range. You can figure out what the difference is between your modified AGI and the bottom range, and then figure out what part of the credit is subtracted and then subtract that amount. Okay, either way, get you the same result. So you can use whichever you prefer. Okay, same idea. This shows from the top of the range, subtracting the modified adjusted gross income, but you can also take modified adjusted gross income, subtract the bottom of the range, and then take out that amount of the credit. Okay, so you need to apply this when we're talking about modified adjusted gross income over these thresholds. So example, pay $2,900 for qualifying expenses for dependent daughter, so everything's working. She's full-time as a freshman. To the AOTC can only be used for the first 4 years of education. So basically a bachelor's degree or equivalent, and they have to be a degree seeking, meaning they have to be on track to actually get a degree more than half time, okay, which isn't that many credits, but it is something to consider. Taking one class isn't going to qualify for AOTC, but it would work for lifetime learning, because lifetime learning credit is broader in what it covers, in that it can be used for graduate education, it can be used for part-time or single courses, that sort of thing. So before you consider any limitations, you take the $2,900, okay, and get the $580 if this was for the lifetime learning credit. That's what the lifetime learning credit would be. But because they're a freshman, they could also qualify for AOTC, which should be better. Okay, and we'll change the AGI to 85,000 in this case. That wasn't given in the first one. 100% of the 2,000, 25% of the second 900, 2,225. Okay, so already we're talking about quite a bit more under the AOTC than under lifetime learning. And it's phased out, that's true, a little bit. In fact, half of it, because they're halfway through the phase-out range. The phase-out range was 80 to 90,000. If this was lifetime learning credit, they'd be past the phase-out range already. Okay, so half of it. So you're going to subtract that, or have left the 113. Half of the credit is actually available to this taxpayer.